So welcome everybody to today's webinar. My name is Nicole McLean. I'm here with Karl Baillie. We are two of the managers here at Vincents Business Advisory Unit, and the purpose for us being here today is to discuss year-end tax planning concepts. So from a general perspective, we know that 30 June falls on a Thursday this year. Whilst tax planning is often conducted in May and June of every year, we believe that tax planning should be more of a continuous year-round consideration. Often 30 June planning results in short-term solutions, whereas real tax planning is usually more structural in nature, and it usually involves reviewing an entity or a group structure, and also the conduct of a business or the investment activities that are being undertaken by that taxpayer or their groups. It's also important to remember that it's potentially risky to undertake a flurry of activity in those final days of the tax year, especially where they achieve a tax advantage. So for example, undertaking a business restructure in the last few weeks of June may look like it's being done for tax reasons, whereas planning or implementing restructure steps over a period of time is more likely to be seen as something commercial. That said, 30 June pre-planning is important and should be considered as a matter of course. So today we're going to discuss some of the key year-end planning issues, and these include reducing assessable income, maximising deductions and offsets where possible, reducing the rate of tax and also deferring payments of tax, and diverting income where possible. Issues surrounding trusts, Division 7A, capital gains tax, and we'll also consider some of the budget changes. We consider structural tax issues are probably outside of today's webinar, but if you have any queries in relation to this, please contact your Vincents advisor or either myself or Karl. I'm going to pass over to Karl now, who's going to discuss income for individuals and business taxpayers.
Thanks, Nicole. Hi, everybody. First up, income for individuals. If you're an individual, generally you're assessed on a cash basis. Wages, dividends and interest are all assessed on a receipts basis, so when you actually get the actual money. The main exception to this is if you're carrying on a business as a sole trader, and then the general rules of accruals will apply. And on that topic, for businesses, as mentioned, businesses are generally assessed on an accruals basis, which means that if you issue an invoice on 30th of June 2016, but it isn't paid until July or August, this would generally need to be brought in as assessable income on your 30 June 2016 tax return. There are some special rules in respect of the assessability of business income, such as income for certain professional practices and long-term construction projects. Also, work in progress may be considered assessable at 30 June if there is a recoverable debt at that stage. It's also important to note that small businesses used to be able to use the cash basis under the old STS rules. However, this has been removed a number of years ago, so it has to be on an accruals basis now. From a tax planning perspective, it may actually be worth reviewing any contracts or agreements to see whether there is any scope to either defer or accelerate the assessability of income as appropriate. It would obviously need to be within the terms of the contract and may need to be agreed upon with both parties to the contract. Under the Arthur Murray principle, income for services not yet provided may not be assessable until such time as the services are actually provided. Alright, trading stock. Alright, it's very important to consider the most appropriate valuation method for valuing your closing stock at 30 June. The three options are cost, market selling value, or replacement value. You are also able to change methods from year to year, so there can be a definite advantage of taking the time to consider the stock valuation for each year. You can also consider absorption costing. This includes bringing in all direct and indirect expenditure incurred in relation to the costs of the inventory. Also very important to identify any obsolescence prior to 30 June. So you need to have a look at your inventory, and the inventory needs to be scrapped and written off prior to 30 June in order to secure the deduction.
So if we move now on to considering how to maximise deductions and start that discussion with some bad debts, We basically recommend that taxpayers review their debtors and identify any that may be bad. We recommend them writing those off, or at least documenting the resolution to write those off. And it's also a good idea to document proof that the debt is actually bad. So for example, this might include the steps that you've previously undertaken to recover the debt and why it is that you believe that the debt is bad. And the other thing that we consider very important in this space is to consider the company and tax loss rules when you're seeking a deduction for bad debts, because they may determine whether you are actually eligible for that deduction or not. And also another key thing to remember is that a GST adjustment is actually generally required for debts that have been outstanding for greater than 12 months. In addition to reviewing a business's debtors, we'd also think it's a good idea to review asset registers, and this can help by maximising in your depreciation deductions. One of the ways to do this is to identify any assets that may have been scrapped or that could be scrapped prior to 30 June and can therefore be written off in the accounts and ledgers. The balancing deduction is actually available for the remaining written down value on those assets. And then still in the space of assets, when you're reviewing your additions for the year, it's important to keep in mind that small business entities are eligible to access accelerated depreciation rules, which at the moment is a very generous $20,000 in value. There's an instant asset write-off for those. I guess just as a reminder, a small business is an entity whose aggregated turnover is less than $2 million. So that test basically looks at aggregated turnover, and we're looking at all entities within a group, and it also works off business turnover. So it's important to remember that a business must be carried on in order to access those concessions. It doesn't apply to entities with passive income. Also remember it is possible to use the ATO effective life of assets. However, they do get updated from time to time, so it's important not to simply rely on the previous rates that you may have used. You are also eligible to use your own rates, but do that at your peril. And also another tip is to identify intellectual property assets that may be eligible for depreciation deductions. These include copyrights, patents, and registered designs, but unfortunately not trademarks. So have a look at your expenditure during the year and identify whether any of them fall into those categories. Also in the deduction space, we wanted to remind employers that they are actually required to make superannuation contributions for employees by the 28th day of the month following each quarter end. However, one way to maximise the deductions is to ensure that the payment of superannuation for the June quarter is actually paid to the superannuation funds prior to 30 June. This ensures that a deduction in the current tax year, rather than delaying it until next year. So for 2016, if you pay your June super by 30 June 16, you'll get that this year instead of having to wait until the 17 tax return. We also recommend it's a good idea to review all of your prior contributions that have been made throughout the year for compliance with the superannuation guarantee obligations. There's some hefty penalties for those that don't comply, so we therefore recommend that you appropriately deal with any contributions that may not have complied with those regulations. And we also remind all employers that they're all required to be SuperStream compliant by 30 June 2016. This includes small businesses. And if you have any questions in relation to that, please do not hesitate to contact your Vincents advisor or myself or Karl at the end or after this seminar. And whilst we're talking about superannuation, we thought it was also just helpful to remind everybody, I suppose, that there are options to make personal superannuation contributions, which are over and above those that you receive under the superannuation guarantee contributions made by your employers. Although in doing so, it is important to keep in mind the appropriate contributions caps, as there are penalties that can apply to those. We're going to go through those caps very shortly. And also to remind everybody that the Division 293 tax kicks in when an individual's adjusted taxable income exceeds $300,000. And this basically imposes an additional 15% tax within the superannuation fund on contributions made for that particular employee. Being aware of that helps to avoid any nasty surprises. I guess here we've supplied the relevant superannuation caps for the 2016 year. So if we have a look, concessional contribution cap for taxpayers under 49 is $30,000, and 49 years or over will be $35,000 this year. And the non-concessional caps is $180,000, or if you're using the bring forward rule, it's $540,000 over the next 3 years. And finally, we wanted to supply some other tips for maximising deductions and offsets, and other things to consider, I suppose. And they include things like donations and also prepayments of expenses. So, for example, where you make prepayments of interest, for example, on a rental property or something similar, although it is important to consider the prepayment rules. So generally cap it to something that's 12 months only. Also bonuses. Employers are actually entitled to claim a deduction for a bonus prior to its actual payment. However, it's important to determine the amount of the bonus that will be paid and to document that decision that you're going to make those bonus payments, and also to inform the staff of the payment that's pending and the calculation basis. And that's all should be done prior to 30 June. That will secure the deduction for those bonuses. And I guess one more thing that we like to do is to remind everybody it's important to review your individual entitlement to private health insurance rebates. These are actually means tested, and being aware of them will hopefully avoid any unexpected surprises on the lodgement of your individual tax returns. I'm now going to pass back to Karl. He's going to go through a couple of other issues, including trusts.
Thanks, Nicole. All right. On to trusts. It's very important to review the trust deed prior to 30 June, as a trust will need to make resolutions by 30 June in order to make an effective distribution for the year. If not effective, the trustee may be assessed at the top marginal rate, and nobody wants that. Your Vincents advisor will generally draft these minutes for you prior to 30 June. So these are all the points here that your Vincents advisor will consider when drafting your 2016 trust distribution minute. Accordingly, it is important that your Vincents advisor is aware of your 2016 financial position and any changes to your personal or financial circumstances during the year, such as a new spouse, new children, or any large one-off CGT events. So I'll just run through them all briefly. So trust income, the way that the trustee defines trust income and the accumulation of the income, who is classified as a beneficiary under the terms of the trust deed, classifications of income versus the capital distributions, whether the trust can stream distributions, the vesting date of the trust, the eligibility of the trust for small business CGT concessions, the trust loss rules, the CGT event E4 if we're looking at a unit trust, and then the TFN reporting and the withholding rules. Now, everybody's favourite Division 7A. Looking at Division 7A for loans from companies, the application of Division 7A will differ depending on when the loan was actually made. So loans prior to December 1997 are quarantined. These won't come under Division 7A as long as they're not touched. We generally don't put any repayments and no further withdrawals on these loans. Loans made before 30 June 2015, they should have a loan agreement already in place. These will need interest applied and minimum repayments in 2016. The benchmark interest rate for 2016 is 5.45%. So loans made during the 2016 year will need a loan agreement put in place prior to lodgement of the company's 2016 income tax return. However, this loan won't need interest and won't need minimum repayments during the 2016 year. For unpaid present entitlements from trusts to companies, unpaid present entitlements or UPEs prior to 16 December 2009, these are quarantined. Again, we generally leave these ones alone and there's no further action required. For UPEs after 16 December 2009, generally these are treated as a UPE for a period of 1 year. After 1 year, they are deemed to be converted to a loan, at which time we will need to consider Division 7A. There are other ways to deal with these loans, but these are the most common ways. On to capital gains tax. So it's very important to remember for CGT purposes, the key date is contract date, not settlement. This means if you enter into a contract to sell an investment in June 2016, but the contract doesn't settle until July or August of 2016, this will need to be included in your 2016 income tax return. Accordingly, if possible, it may be worthwhile delaying the signing of the contract until after 30 June, obviously if it's possible. Beware of wash sales. So the ATO has been looking at these. A wash sale is where a taxpayer realises a capital loss prior to 30 June and then repurchases the same or a similar asset, essentially to crystallise any capital losses sitting in an asset. The ATO considers that wash sale arrangements fall afoul of the general anti-avoidance provisions of Part 4A. And finally, it's also important to note whether any CGT discount or any other CGT concessions may apply. All right, on to the budget changes. Now, it's important to note that these are currently proposed budget changes and they're not law. So really, depending on how the federal election goes in July, will affect whether these actually come through or not. So the 37% marginal tax rate for individuals will increase from $80,000 to $87,000 of taxable income. The small business entity turnover threshold will increase from $2 million to $10 million. And the small business corporate tax rate will reduce to 27.5%. So this isn't for all companies, it's only for companies that are carrying on a small business. There's also a number of proposed tax incentives to promote investment in the early stages of innovative companies. And also the transfer pricing rules are going to be tweaked in order to give rise to various OECD recommendations.
So that's basically all we have for you today. We do see that some of you have sent through those questions, and thank you for those. We'll get back to each of you individually shortly. Otherwise, I guess, should you have any queries, please do not hesitate to contact either Karl or myself or your Vincents advisor. And if that also applies if you wanted to discuss any of your 2016 tax planning for your specific circumstances or even just generally. So thank you very much, everybody, for attending today's webinar, and we hope you got something out of it.
Thank you.
Thank you.